$52.3 trillion. That is the estimated size of China's total debt today. To put that number into perspective, it is larger than the combined annual economic output of the United States and the European Union. It is the largest accumulation of debt ever recorded by a single economy. Yet despite its scale, China's debt problem is widely misunderstood. This is not a story about foreign creditors forcing a crisis. It is not a sudden collapse driven by currency panic. And it is not a repeat of the 2008 global financial crisis. China's debt problem is far more unusual and far more structural because China did not borrow from the world. It borrowed from itself. And that distinction changes everything. The model that built modern China. For over 4 decades, China followed one of the most successful development strategies in modern history. The model was simple in theory: suppress consumption, channel savings into investment, build infrastructure at scale, expand industrial capacity, export to the world. This strategy transformed China from a low-income agrarian economy into the world's second largest economy in less than 40 years. But this model relied on one critical assumption: that investment would always generate returns higher than its cost. For a long time, it did. Early investments in roads, ports, factories, and housing delivered enormous productivity gains. Debt fueled growth, and growth made debt manageable. But as China became richer, that equation began to change. When investment stops paying off, as economies mature, investment returns naturally decline. Building the first highway between 2 cities creates massive value. Building the 10th parallel highway does not. China continued to invest at extraordinary levels even after the most productive opportunities were exhausted. At its peak, China invested more than 40% of its GDP every year, far higher than any major economy in history. This required one thing above all else: debt. And debt in China did not come primarily from households or the central government. It came from local governments and state-linked corporations. Local governments and the illusion of revenue. China's local governments face a unique constraint. They are responsible for infrastructure, public services, economic growth targets, but they are not allowed to freely raise taxes. To bridge this gap, they turned to borrowing. Local governments created special entities known as Local Government Financing Vehicles, LGFVs. These entities borrowed heavily to fund development projects using land as collateral. This created a powerful incentive structure. Local governments sold land to developers. Developers borrowed to buy land. Banks financed both sides. Rising land prices funded public budgets. For years, this system appeared stable because land prices kept rising. But this stability was conditional. Once property prices stopped increasing, the entire mechanism weakened. Property as China's financial backbone. No sector absorbed more debt than real estate. At its peak, property and construction accounted for nearly 30% of China's GDP when upstream and downstream industries are included. Housing became more than shelter. It became a savings vehicle for households, a revenue source for governments, a collateral base for banks. Chinese households invested a disproportionate share of their wealth in property, often owning multiple apartments. This worked as long as prices rose. When prices stagnated, the risks became visible. Developers, defaults, and delayed reality. China's major property developers expanded aggressively using leverage. Many relied on pre-sales, selling apartments before they were built, to fund construction. This system worked only if confidence remained intact. When sales slowed, developers faced liquidity shortages. High-profile defaults followed, including Evergrande and other large firms. But these failures were not isolated accidents. They were symptoms of a system that had reached its limit. Rather than allowing a rapid collapse, authorities opted for gradual containment. Projects were delayed rather than canceled. Losses were absorbed slowly rather than recognized immediately. This avoided short-term chaos, but extended long-term weakness. The banking system's quiet burden. China's banking system is large, centralized, and closely linked to the state. This structure provides stability, but it also obscures risk. Many loans tied to property and local governments have been extended, restructured, or rolled over rather than written off. This practice, often called evergreening, prevents defaults from appearing in official statistics, but it does not eliminate losses. It distributes them over time. Banks become less willing to lend to new, productive sectors. Capital remains trapped in low-return assets. Economic dynamism declines. This is not a crisis of collapse. It is a crisis of stagnation. Debt sustainability and the growth problem debt is not inherently dangerous. What matters is whether an economy can grow faster than its debt burden. For years, China could. Today, growth is slowing. Structural factors are responsible. Declining productivity gains. Saturation of infrastructure investment. Weaker global demand. Lower private sector confidence. As growth slows, debt ratios rise even if borrowing slows. This is the core of China's dilemma. Reducing debt risks, slowing growth further. Stimulating growth risks, increasing debt. There is no easy path forward. Demographics make the problem harder. China's demographic outlook compounds its debt challenge. The working age population has peaked. Birth rates are at historic lows. The population is aging rapidly. This matters because debt is serviced by future income. Fewer workers supporting more retirees means higher fiscal pressure, lower consumption growth, reduced flexibility. Japan faced a similar challenge, but Japan entered stagnation as a high-income economy. China is facing it at a much lower income level. This makes adjustment more difficult. Why monetary policy has limits. Some argue China can simply print money to solve its debt problem. In practice, this approach has limits. China operates a managed currency system with capital controls, excessive monetary expansion risks, currency depreciation, capital flight, loss of confidence. Unlike the United States, China does not issue the world's reserve currency. Stability depends heavily on credibility. This is why stimulus measures have become more cautious over time, smaller in scale and targeted in scope. The ability to buy time is diminishing. Political priorities and economic trade-offs. Under Xi Jinping, economic priorities have shifted. The focus has moved toward financial risk control, state dominance in strategic sectors, reduced reliance on speculative growth. While these goals aim to improve long-term stability, they also reduce short-term growth. Private investment has slowed. Entrepreneurial risk-taking has declined. Foreign capital has become more cautious. Debt systems depend on optimism about the future. When expectations weaken, debt becomes harder to sustain. Why China's debt crisis is different. China's situation differs fundamentally from debt crises in emerging markets or Western economies. There is no sudden foreign creditor panic. There is no currency mismatch triggering collapse. There is no single moment of failure. Instead, adjustment happens internally. Losses are absorbed gradually across households, banks, and governments. This makes the system resilient, but also rigid. The cost is slower growth over many years rather than a sharp crisis. Global implications. China is deeply integrated into the global economy. It is the world's largest consumer of many commodities and a central node in global manufacturing. A prolonged slowdown affects commodity exporters, emerging markets, global trade volumes. This is not a scenario of global collapse. It is a scenario of lower global growth, and that impact accumulates over time. The end of an era, not an end of China. China's debt problem does not signal imminent collapse. It signals the end of a growth model. The era of debt-fueled, investment-led expansion is over. The transition to a more balanced, consumption-driven economy will be slow, complex, and politically challenging. Debt will not disappear, but its ability to drive growth has reached its limit. This is not a crisis that explodes. It is a constraint that tightens, and the world is only beginning to adjust to that reality.